I am Dr. Shivaram Krishnan. Welcome to this video on identifying the nature of items and recording these items. In this video, you will study about the nature of accounting items so as to distinguish between amounts which are of operational nature and those which are of permanent nature. You will come to know that the same item can be operational for one type of business and permanent for another type of business. At the end of this video, you will be able to differentiate between fixed and current assets. You will be able to distinguish items as income and revenue expenditure, or what is known as operational expenditure. You will also be able to record these items using the dual concept. Now, we saw several items. One was furniture, then we saw capital, then we saw cash. So we saw these three items. And we also saw shirts. We need to understand the nature of these items. The business is established to sell shirts and trousers and then make a profit out of them. In accounting, the nature of items are categorized under specific terms in order to distinguish them. Some items assist in making a profit for the business. Some items continue to remain in the business, not to be sold. Furniture which was purchased is not for sale. On the other hand, shirts which were purchased is for further sale. Therefore, furniture will be there in the business almost permanently in our enterprises, and therefore furniture can be called as a fixed asset. The word fixed helps us to understand that the asset will be there for quite some time in the business. On the other hand, shirts is a stock of saleable goods, and therefore these shirts are called current assets. Now you can see the difference between fixed assets and current assets. Cash is also a current asset because it changes its form. From cash, one can turn it into shirts, and if shirts are sold, they go back into cash. So cash is also a current asset. For a business enterprise which buys, lathe machines, the lathe machines become current assets. They are not fixed assets because these lathe machines are to be sold. Similarly, for a business which is in the business of constructing flats and selling them, the flats become the current assets, whereas the cranes, the dumpers, the concrete mixers will become the fixed assets. There are certain items which are in the form of operational expenditure, which are incidental to the purchase and sale of certain items. Let's see this. Our enterprises paid conveyance charges rupees 300 in order to bring the shirts to the business. This results in an increase in expenditure, which is conveyance, which is an operational expenditure, rupees 300, and a decrease in current asset, cash rupees 300. If you insert this in the table which we saw earlier, this is how the table will look. On the liability side, rupees 50,000, which continues. On the asset side, you have cash rupees 19,700, furniture rupees 20,000, shirts rupees 10,000, and conveyance charges rupees 300. And still the total on both sides is the same. Now, expenditures like conveyance, salaries, wages, electricity are all called revenue expenditure or operational expenditure, unlike the expenditure made on fixed asset. So, the expenditure on furniture is a kind of capital expenditure, whereas the expenditure on conveyance is a operational or revenue expenditure. Let's see some more transactions. R Enterprises sold all the shirts for rupees 15,000. What does this result in? In the form of a dual entry or a dual outlook. This results in an increase in current assets, namely cash rupees 15,000, and a decrease in the stock of shirts rupees 10,000, along with an increase in income rupees 5,000. How do we represent this in the table format? In the table, the liability continues as rupees 50,000. On the liability side, there is an income of 5,000, because this income belongs to the owner R, which means the business is responsible for this income to the business R. On the asset side, cash has gone up because there was a sale of shares, and this cash now becomes 34,700. Furniture continues to be 20,000. Conveyance charges continues to be 300. Some more transactions. The business received a loan of rupees 30,000 from Punjab National Bank. This results in an increase in current assets, cash rupees 30,000, and an increase in liability. What is the liability? Loan from PNB rupees 30,000. And see how it looks when it is put in a tabular form. Liability continues to be 50,000, income from sale as 5,000, and loan from PNB is now added on the liability side 30,000. What happens on the asset side? Cash goes up by 30,000. Now the cash becomes 64,700, and the furniture continues to be 20,000 and conveyance as 300. This is one more transaction. A part of the loan is paid. So, paid part of the loan from PNB rupees 5,000 in cash. This results in decrease in the liability, loan from PNB rupees 5,000, and also a decrease in current asset, cash rupees 5,000. Now, this is how the table looks. Let's see further. When we look at all the transaction as a whole, what has happened? There is an increase in asset along with a decrease in asset or an increase in liability or an increase in income. Secondly, there could be a decrease in liability along with a decrease in asset. Thirdly, there could be an increase in expenditure along with an increase in liability or a decrease in asset. It will be easier to reflect on a couple of examples we cited before and remember this. This dual outlook which we saw is to be converted in technical terms in accounting known as the debit and credit of transactions. Having seen this video, let us see what we have learned. Number one, that items purchased and those that are not to be sold are called fixed assets, whereas items that are to be sold are called current assets. Number two, the proceeds from sales are known as income, whereas expenditures such as conveyance, salary, wages, electricity are known as revenue expenditure or operational expenditure. Thirdly, you also learned that the balance in the table is continuously maintained by recording transactions as both liabilities and assets.